Most beginners put their money into the wrong place. Not because they're careless, but because nobody explained to them the differences carefully. Now, in this video, I will explain the difference between stocks, ETFs, and saving accounts. So you know exactly what each one of them is for. And more importantly, which one is the right one for beginners. So welcome back to Wealth Town. I'm Norbert Meinhardt, and this is where we build and protect wealth. Now, this is module 4 or lesson 4 of the Stock Investing for Beginners course. So make sure you're watching this playlist in order. And don't forget, you will need pen and paper for this course because I'm not going to give you everything. Mostly I'm going to talk and you have to write it down. So let's get started here with part 1, which is going to be saving account. So this little fellow is going to represent our saving account. We're going to put it here to the right side. After that, we're going to have stocks, and then we're going to have ETFs. So saving accounts. Let's start with let's just say the most known to each and every one of us, saving accounts. Basically, you go to the bank and put your money in there for X amount of time. So basically, you're going to take your cash, in whichever currency that would be, and just put it in the bank for X% and X, let's call it Y time. And after that time is over, you're going to get back your initial investment plus X, whatever X has resulted. Let's say that X is 2% and this is 100. Then at the end of the day, you're going to have 100. At the end of time, going to result 100, and there should be 102, whatever it is, dollars, let's say. So once again, take your money, put it into a saving account for a defined amount of time and for a defined amount of return on that investment. And at the end of time, you're going to get back your money plus the agreed upon savings amount. So what are savings accounts actually good for? Let's create here a little list and explain what they're good for. Mostly they're good for 3 things. Emergency funds. Let's say something happens and you need that money. Worst case scenario, death. Not a bad scenario. Let's say you're going to lose your job and you're going to need to have those 3, 6 months or even 12 months or 1 year money saved up until you get a new job. That's what savings accounts are for. Now, in most cases, you will lose the interest on that money if you withdraw your money earlier, but that is in case something happens. So in case nothing happens, you're still going to end up with your money after that time. But if something happens, emergency fund is this is where you would use your emergency funds. Lose your job, some serious medical problems, so far and so on. Or short-term needs. Let's say you're saving up for a car, you have to put that money in there because you don't have enough money. Let's say you already have 10,000, but you need 20,000, so you're going to take that 10,000, put it into a savings account, and then for 1 year, you're going to save up the next 10,000 or just 10,000 minus the amount you're going to receive on the savings account, and voila, you are quicker at your endpoint. Or safety and liquidity. You just want to feel safe. Your wife asks or your spouse asks, hey, what are we going to do if something happens? You're going to say, hey, relax. We have some money saved up. So we also have liquidity. So liquidity means, I'm going to give you 2 polar examples for liquidity. House, illiquid. Savings account, very liquid. Most liquid, money in your pocket. That's the most liquid because you don't have to go to the bank and pick it up. But house, you have to list it, find a buyer, sell it, pay your taxes, so far and so on. So until you get that money, man, I wouldn't say that houses are an investment. They are long-term. I only would buy a house we're going to talk about houses a little bit later on in investing. Only buy houses for memories. Okay, so create some memories with you and your family. But once again, savings accounts are emergency funds, what are good for emergency funds, short-term needs, and safety and liquidity. So saving accounts are safe. Well, to summarize this up, your money does not go up and down. It doesn't fluctuate with the market, but there's a small little problem. And this is where I would always say that savings accounts should be for maximum 1 year if you sign a contract with them, because over time, inflation slowly reduces your purchasing power. Meaning, if inflation is 2% in January, and you're going to take $10,000, have it in January, don't invest it anywhere, go to next January, the next year, you're going to have 2%, if the inflation is 2%, 2% less buying power. Not less money, less buying power. You can buy less with the same amount of money. But saving accounts protect nominal value, but they don't build wealth. This is why you're here. You want to learn how to build wealth and learn about the stock market. So next we're going to move up to the second part, which is we're going to talk about individual stocks. Let's move that basket down there. Individual stocks. And this is where it's going to get really interesting. Just zoom in here a little bit. Now, let's talk about stocks. A stock means owning one specific or part of one specific company. When you buy a stock, you buy one part of one specific company. So there are some pros and cons to this. Let me just put the sign there. And we're going to first of all, start up with props. There are two props actually. High potential return. Potential return. Really, really careful with this word. Potential. You have the potential of a return, don't have the guarantee. And ownership in a business. Well, kind of. Because you don't actually own the entire business. You own little parts of that business, depending on how much stock you bought. Remember, one really important thing. Your money in that savings account has a second problem, not that big of a problem. In case of a bank run, your bank does not have that actual money. So there are regulations. Please read your regulations in your country that you live in. But there are certain regulations. A bank has to hold X amount of liquidity equal to how much money they have from investors. Let's say 10 people invest $1,000, and that's $10,000 total amount in the bank. Well, the bank only has to have not the entire $10,000. They will take that money and invest it. They only have to have X amount of that. Let's say 2%, 10%. I don't know. Depends. Okay. So the problem is that there are laws that when everybody goes to get their money, the bank is going to say, "I'm out. Don't have that money." What do you mean you don't have my money? I want my money. Well, I will give you what the law says that I'm obligated to give you, and that is going to be a X amount from that fund. I believe in the US is 200,000. Europe is 100,000. So $200,000. But please, this constantly changes. Regulations change, laws change. That's the maximum amount. You have 1 million, they're going to give you back 200,000. That's it. If the bank goes bankrupt, they're not going to return to you your entire savings. They're only going to return part what they are legally obligated. Not even there. Them somebody else is going to return it, the government or something like that, but not 100%. You're going to, so don't think that they're actually safe. They're kind of safe. So you're just safe. Savings accounts are safe till a certain amount. Okay. On the other hand, stocks, ownership in a business. Now, when you buy a stock, you have that paper, you own that paper. Okay. It's stocked somewhere. When you buy it from a phone, you don't actually see it. But the bank stocks that paper. If you actually buy stock and not CDs, then they're obligated to stock that somewhere. So you do have, if the bank or if the app that you're using or your broker goes bye-bye, you still have ownership of that. So you're going to get that back, the ownership, okay? If the stock already went down 100%, that's it. You lost all your money, but you still own that paper, okay? If it ends up at $1 and you bought it at $100 and it comes back to and has then a value of $200, then you still have the paper that is going to be worth then $200. So just a side note, okay? This is really, really important to know about props for a stock. So this ownership is really important. When you give your money to the bank, you no longer own your money, but you do own the paper that is the stock, okay? But there are cons, especially for beginners, also for, let me just copy this. There are also cons to this, to owning stocks, and those cons are as following. There's a high risk if poorly chosen. You just chose stocks. We're going to talk about stocks later on in the course, how to filter them a little bit. For example, low liquidity, you just cannot sell that stock. For each trade, there has to be a buyer and a seller, okay? Otherwise, the trade does not happen. If you are selling your stock, you want to sell your stock at 100 and nobody wants to buy it at 100, they have to lower your price until somebody buys it. For high liquid stocks, it's not a problem. For example, Microsoft, Apple, just talking about current situation. Nvidia, it's high liquidity. Everybody owns their stocks. Everybody is going to trade it. Somebody's going to think that it's worth more. Somebody's going to think that it's worth less. So high liquidity really helps with the stock. And that is one of the criteria when you're choosing your stocks, not choosing it poorly, is to have high liquidity. Then another con would be requires research. As I said, part of liquidity, finding out how liquid the stock is part of the research. You need to do your own research. I'm not going to teach you here stock research. That's all on you. You need to do your research. If not, then you're going to wind up here with, again, chosen poorly and emotional decisions making. So stocks are volatile. You can go up and it could go down. And research shows that the pain of, let's say the stock is at 100, the pain of a stock going down 10%, so going down $10 to 90, is greater than the stock going up 10%, so 110, when you feel it. So the pain is greater than the joy, although the amount was exactly the same. And when you're going to feel that pain, you're probably going to sell. And that is emotional damage. And that is emotional decision making. Be very, very careful with this little fellow right here. Emotional decision making. This is why, again, choosing stocks poorly ends up in losing money. Choose your stocks wisely. Choose good stocks, highly liquid. We're going to talk about this a little bit later on, because if the stock falls, I'm just going to give an old example. The stock goes up massively, aka GameStop, there will come a time when it's going to calm down heavily, and you either sold. Remember, if you want to make gains, you have to sell your stock. It's the only way you're going to make gains on the stock. Otherwise, you just see numbers going up and down. Nothing happens. If you didn't sell there, the stock goes down 80%, then you're going to feel pain. So be careful of choosing stocks, because that can affect you emotionally, and then you're going to make emotional decisions. Going to lose a lot of money. So stocks are powerful, but for beginners, they can be dangerous without knowledge. Remember this, dangerous without knowledge. One bad decision can hurt confidence for years. You're going to feel that pain for years. Just an example, I'm going to give you a very quick example here. This is a stock diagram, but this is perfect. This is Citigroup. Citigroup is up, let's say here, is up for year to date, for the year. So not year to date, but for one entire year, it's up 27%. In 5 years, it's up 98%. And all time till the stock was released, it's up 72%. So there's a kind of a discrepancy here. Do you see this? Let me actually go up here. 98, 5 years, 72, all-time high. Why? Let me show you something. Let's go back to the diagram. So this is a uptrending line. Stock is up. And let's go to all-time highs. All times, and click here on all time. Do you see this major fall here? This was in 2008. Now, since then, where the stock was at $567 a share, it fell down to let's call it a $13 a share. And since then, it recovered to $116 a share currently. So be very, very careful with this kind of parabolic moves, because one day they are going to come down. Now this one was a very specific Citigroup problem, bank problem. This is actually a bank that did some kind of shenanigans, allegedly, and the stock suffered for it. And right now it is historically overbought. So sit tight, because this is going to come back once again. Remember this for the future. Be very, very careful with choosing stocks. Okay, let's move on to part number 3, which is ETFs. And where's our basket here? Now we need our basket, the last one, the fruity basket. Now let's talk about ETFs, which are the middle ground. And these are exchange, E, traded, T, funds, F. Okay? Exchange traded funds. Basically, a ETF is a collection of multiple single stocks. Okay, take a single stock, throw it in a basket, take another single stock, throw it in a basket. Didn't give here any kind of specific stocks. I just chosen a fruit basket because that's kind of what it is. It is mixed. I also didn't want to prioritize ETFs, certain companies here. Instead of beating one on one company, you're investing in multiple companies. You're investing in dozens of companies, hundreds, or even thousands of companies. Now, this is called, and you need to write this down, a ETF is a diversified investment. So ETFs represent diversification. Okay, ETFs reduce the risk by spreading it, and they're also ideal for beginners. Now, a couple of caveats. Be very, very careful. There are also sector ETFs. I'm going to give the first example, which is the most beginner-friendly, a S&P 500 ETF, which kind of reflects the S&P 500, the top 5 companies in the US stock market. So you're kind of safe there, kind of, okay? Look back at Japan, what happened with them in the 90s. So you're kind of safe there. They're going to take the top companies, the best companies, best 500 companies, and build a basket for you. Now, there are also sector ETFs. Sector ETFs are going to take the top companies from specific sector. I'm just going to show you now a specific sector, which is basically known to all of us today. The XLK, that's the ETF name, which is the State Street Technology Sector, Selector Sector, SPDR, which stands for Spider ETF. Okay, and they hold NVIDIA, Apple, Microsoft, Broadcom, Micron Technology, Advanced Microcomputer, Planetary, blah, 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 so far and so on. They hold a lot of companies, and you can see also their weighting in them. 15% NVIDIA, over 12%, Apple, over 10%, Microsoft. Now, this is also a caveat here that is not actually, I think they rebalance once a year or not even at all. As soon as the stock goes up, the weight of the company in this ETF grows. So this is kind of too much information for right now, but this is a sector-specific ETF. This is a technology ETF. I'm going to also show you a energy ETF, focuses on energy, of course, which is the XLE, and their holdings are as following. Top holding, of course, ExxonMobil, then comes Chevron, then ConocoPhillips, SLB, which stands for Schlumberger, Williams Cos, and so forth and so on. Different weighting. Just take a look here. This ETF is heavily weighted on ExxonMobil. So when you're buying these ETFs, you're basically buying only 2 companies, as ExxonMobil and Chevron. They together make up over 40% of this ETF. Put a ConocoPhillips and SLB to it, and voila, you have 50% of the ETFs in 5 stocks. So be very careful with this kind of ETFs. They are single ETFs, and we're going to talk about ETFs later on in this course when we're going to focus only on ETFs. Also, one stock ETFs, which are free factored, and that is extremely dangerous. Just going to say 2 times or 3 times NVIDIA. Very dangerous. So let's move back to our presentation here. And the gist of it is that ETFs are a basket of companies. You're diversified when you're investing in an ETF. You're basically diversifying your holdings in different sectors and different stocks. But due to the fact that technology really exploded in the last couple of years, the main ETF, the S&P ETF, is really, really top heavy, meaning the concentration in the top is in technology. If technology falls, it's going to bring down an entire ETF if there's no rotation in the market and people invest in something else like healthcare, commodities, and so forth and so on. So this is basically what you need to know about ETFs. Now, part 4 will be now about comparison. So what should we take away from each of them? There's a very simple way of thinking about them. And I'm going to create here 3 categories, which we already talked about. So we have our saving accounts, then we have our individual stocks, and then we have our ETFs. And let's talk about each one of them. So I'm going to move this here, and this fellow here. Remember, you have to write this down, and let's just do here a quick comparison of this fellow. So first of all, saving accounts, they're safe, no growth. The money does not grow, excepting that the percentage that you agreed on, and it's short. It should be short term. Always invest for the short term when you have it in your that's your thinking short term investing account. On the other hand, individual stocks have higher risk, higher reward, risk and reward, and require a little bit of skill. Not a lot. Well, maybe a lot if you invest a lot in them. The more you invest, the more you risk to lose. How much can you lose when you invest in a stock? Exactly the amount that you invested. If you invest $100, you can lose that $100. Last but not least, the ETFs are balanced risk, long-term growth, beginner friendly. But be careful with what I said. Do not invest in single stock ETFs, or be very careful with sector ETFs. If you're trying to play the sector game, you have to also rebalance that sector. One goes up majorly, the other one goes down majorly. You have to rebalance that. We're going to talk about that later on. So most beginners should, not a recommendation, not a financial advisor, should start with an ETF, a really diversified ETF, even a world ETF, not because they're exciting, but because they work and they're safe and the risk of losing your entire savings is less. Now, if you're talking about risk, let's also talk about a couple of common beginner mistakes. Mostly beginners make the sort of we're going to go all in mistake here, and that can really hurt your investment for the long term. So one stock, one idea, one trend, that's speculation. If you think that specific stock is going to go up to infinity and beyond, then you will be wrong sooner or later, but that is just a function of time. Everything that goes up is going to come down again. The law of large numbers says nothing can go up infinitely. It will come down to its long-term moving averages. And it just showed you here, this is long-term moving averages, those lines there that you see, go to only 1 year. We're going to talk about technical analysis another time. 20-day, 50-day, 100-day, 200-day moving average. This is a bullish trend, but on the upside, this is actually was a bearish trend. So the stock just fell, and it always will come back down to its 20, 50, 100, and 200-day moving average sooner or later. And then maybe the stock recovers, the company recovers, and the stock can go upwards from there. So now you should understand the differences. And next question is obvious. What is a ETF really and how does it work? And that's going to be the topic of discussion for the next video. So if you liked it until now, like and subscribe. Also, if you have any kind of questions, leave them down in the comment section below. The channel is about clarity. This is about clarity, what I'm doing here, simplicity and long-term wealth. So see you in the next one, which will be lesson 5 ETFs for beginners. Okay, catch you next time. Bye-bye.